Do you think you're actually going to get your tax refund in 2026 after you file your 2025 tax returns if you're delinquent on your student loans? Well, I'm here to raise the alarm, sound the alarm, raise the flags. If you are delinquent, there is a very good chance you will not see your tax refund for your 2025 taxes. After years of pandemic-era reprieve, millions of Americans with student loans are now facing a financial storm that very few are talking about. The promised relief of widespread debt cancellation, it never materialized. And instead, borrowers are paying the piper in harsh ways. Credit scores are plunging. Wage garnishments are resuming, and tax refunds, which many rely on as a yearly financial boost, are at risk of being snatched away to cover overdue loans. This convergence of factors could have a ripple effect on the broader economy, from consumer spending to the housing market. It's an unfolding situation that deserves a closer look. A recent graduate holding a student loan invoice instead of a diploma symbolizes the weight of education debt right now. Credit scores plummet as your payments restart. For nearly 3 years, federal student loan payments were on pause and delinquent accounts were not reported to the credit bureaus. That all changed once the on-ramp period ended in late 2024. As loan services began reporting missed payments again, borrowers' credit scores have taken a beating. The Federal Reserve Bank of New York estimated that over 9 million student loan borrowers will suffer significant drops in their credit scores as new delinquencies hit credit reports in early 2025. In fact, the first quarter of 2025 already saw 2.2 million borrowers experience roughly a 100-point credit reduction in their score, and another 1 million suffered a 150-point reduction in their score. Such declines are comparable to the damage from a personal bankruptcy and can wreak havoc on individuals' financial lives. Why are scores falling so dramatically? When a federal student loan becomes 90 days past due, it is now reported as delinquent, ending the pandemic era clean slate. Credit scoring models punish these delinquencies severely. Research confirms that even one new student loan delinquency can slash a credit score by well over 150 points on average. Those with excellent credit, say around 750, 760, are especially vulnerable. The New York Fed found this group's scores dropped 171 points on average after serious delinquency. To put that into perspective, a borrower with a 760 score, solidly a prime borrower, could be knocked down to 590. At 760, you can easily qualify for a conventional mortgage at the best rates, but at 590, you're barely in range for an FHA loan and will face higher rates, extra closing costs. As one analyst noted, a drop of this magnitude in score could torpedo home buying plans for many aspiring homeowners. In short, millions of Americans are waking up to find their credit suddenly dropping off a cliff, in the words of one affected borrower. After years of not having to worry about any sort of loan payments towards their student loans whatsoever. Another shoe is about to drop. Tax refund seizures. Starting in mid-2025, the federal government has reinstated aggressive collection tools for defaulted student loans. The U.S. Department of Education announced that as of May 5th, 2025, it's resuming collections on defaulted loans, including administrative wage garnishments, taking a cut of your paycheck if you don't know what that is, and the Treasury Offset Program, which intercepts federal payments like tax refunds and even Social Security checks. In other words, if you've let your student debt go unpaid for too long, you might not see that nice tax refund check coming this spring or starting in January. The government can snatch it from you and put it towards student loans arrearage. This is a big deal because a lot of Americans count on this tax refund. Roughly 2/3 of U.S. tax filers receive a refund every year, with an average refund of $3,100. For families, that refund isn't extra money. It's used to catch up bills, pay down debt, or make major purchases that have been deferred. In fiscal year 2024 alone, the IRS issued 117.6 million refunds to individuals, totaling $461 billion cash returned to taxpayers. Now consider, millions of those taxpayers already carrying student loans, and as of 2025, 1 in 4 student loan borrowers are delinquent by 90 days behind on their payment. All of those folks are at risk of having their refunds snatched, taken right away. Historically, this has hit lower income families hard. Even prior to the pandemic, about 1.3 million earned income tax credit recipients, working families often living paycheck to paycheck, had their tax refunds seized over student loans in a single year. It's not hard to imagine the hardship when a family is expecting a few $1,000s in April, suddenly sees that money just vanished into the air into an educational debt that they've been struggling to pay. It's time to pay the piper. There is an economic ripple effect. What happens when tens of billions of dollars are effectively pulled out of household pockets due to renewed loan payments, lost refunds, and wage garnishments? Economists are watching closely, and there's some concern that it could dampen consumer spending at an inappropriate time. An estimate by Bloomberg Economics suggests that widespread student loan defaults and the forced collections that follow could reduce U.S. consumer spending by up to $63 billion per year. That's money that won't be spent on groceries, cars, appliances, or dinners out. A potential hit to businesses when the economy is already navigating inflation and uncertainty. Lawmakers like Representative Ayanna Pressley have warned that restarting these harsh collection tactics now will further drag down an already struggling economy, directly siphoning resources from millions of working class. There's also a cascading effect to consider. Faced with the government's heavy-handed tools like wage garnishments up to 15% of pay and intercepted tax refunds, borrowers might reshuffle their financial priorities in ways that affect other markets. One credit risk expert noted that if Uncle Sam is being too aggressive about collecting student loans, consumers may decide to pay their student loan debt first and let other obligations slide. In other words, expect a payment hierarchy to shift. We could see more people falling behind on credit cards, auto loans, and other bills like mortgages as they try to avoid the severe consequences tied to student loan default. That means higher delinquencies in other credit segments, which is not great news for banks or the retail sector either. It's a zero-sum game for a stretched household budget. Whichever bill is deemed less dangerous to skip, it will get skipped. Here's some housing market headwinds from the credit crunch. The pain in credit scores and finances could hit real estate market as well. Young adults in their 20s, 30s, and 40s make up a large share of first-time home buyers, and many of them have student loans. Even before the payment pause ended, student debt was cited as a major barrier to homeownership. One 2021 NAR study found over half of student loan holders said their debt delayed them from buying a home. This is student loan debt. Now, add in a new wrinkle. Thousands of potential buyers just saw their credit scores drop from the high 6s or the 7s into subprime range due to a reported delinquency. As noted, a single missed loan payment can knock a good credit score down 100, 150 points, which overnight can disqualify borrowers from a conventional mortgage. Mortgage lenders typically require a minimum credit score of 620 for a conventional loan and even higher for the best interest rates and best closing costs. A borrower who was on the cusp of buying may now find they no longer qualify or must accept a loan with a much higher interest rate and fees due to their damaged credit. This shrinks the buyer pool just when we need it most. Sellers already facing a cooler market in many areas might see fewer offers, and home builders could feel the pinch if entry-level buyers delay purchasing. In short, the student loan fallout is another factor squeezing the housing market, complicating the path to homeownership for a generation that has already been through a ton of economic upheaval. There's also the income side. Borrowers resuming payments or getting wages garnished have less cash for savings of a down payment. Many rely on tax refunds for that extra boost towards closing costs or down payment, and as discussed, those funds might go away altogether. All these effects underscore how interconnected personal finance is. Student debt doesn't just affect students. It can spill into everything from whether a family can buy a home to what neighborhood may see new home demand. This is a macroeconomic second-order impact that isn't always obvious, but it is very real. Employers are dangling student loan relief as a perk. Amid the tough landscape, an interesting development is emerging in the job market. Some employers see an opportunity to attract talent by easing their student loan burden. In recent months, certain industries, especially the government agencies and public service, have begun offering unprecedented incentives related to student loans. A notable example is the U.S. Immigration and Customs Enforcement, ICE, which launched a recruitment drive with an eye-popping perk. Signing bonuses up to $50,000 and as much as $60,000 in student loan forgiveness for new hires. These incentives are far above the norm. By comparison, the U.S. Army long-time loan repayment program typically maxed out around $65,000 over a several-year enlistment. ICE's generous offer, funded by big budget increase, signals just how acute their need for personnel is and powerful student debt relief has become as a recruiting tool. If you're a young professional drowning in student loans, a job that instantly wipes out a chunk of that debt can be life-changing. It raises the question, will more employers, military, follow suit? The armed forces have faced recruitment challenges lately, and one could imagine a renewed push to entice recruits with a promise to eliminate their student debt. State and local governments, too, might leverage similar programs to fill teacher, nurse, or law enforcement shortages. Essentially, student loan forgiveness is becoming a form of a signing bonus. While this can help individual borrowers and fill critical jobs, it's really a transfer of debt burden from individuals to the public or the employer's budget. The ICE example shows that federal government itself is using debt relief as a carrot in at least one of the areas. In a roundabout way, that means taxpayer dollars are being used to extinguish some student loans, turns out. Just not through the broad cancellation that was once proposed, but rather through a targeted employment incentives. It's an approach that may gain traction if the student debt crisis continues to spill into the labor markets. There's a storm on the radar. The intersection of student loans with credit scores, tax refunds, macroeconomic trends is complex and an unprecedented story. Millions of Americans are now grappling with the reality that their financial cushion, be it a good credit score or an annual tax refund, isn't as secure as it seemed during the payment pause era. The return of student loan obligations is pulling money out of household budgets and knocking consumers' creditworthiness down a significant amount at a time when the costs are high and economic growth is certainly uncertain. Will this trigger a broader slowdown in spending? Perhaps not a recession by itself, but it could be a significant headwind in certain sectors. Fewer younger buyers in the housing market, a dip in retail sales as refunds shrink, higher default rates in consumer credit. These are all plausible outcomes if this trend continues. Ultimately, this situation underscores a broader truth. Personal debts, when large and widespread enough, can become a matter of public concern. What might seem like an individual borrower's issue, a defaulted student loan, can aggregate into something that affects housing markets, consumer spendings, and even workforce recruitment. The student loan system stresses are now radiating outwards. It's an issue that consumers, industry professionals, and policymakers alike should keep on their radar because its impacts are being felt on multiple levels of the economy. We are only beginning to understand the long-term implications of this grand experiment, the sudden starting and stopping of trillions in student debt payments. And it certainly gives us plenty to theorize about in the months ahead. And that, my friends, is guaranteed. Keep it on your radar. Pay attention. If you're behind on your student loans, you need any sort of help, comment below. We'll do everything we can to provide you any resource we possibly can that will be beneficial. I wish you the best.